Okay. And you mentioned autocalls there, and they're otherwise termed kick-out plans. What are they?
Right. It sounds a bit derogatory, kick-out. These are investments which are designed to pay you a fixed return for each year that you've held it. Typically a fixed return for each year they've held it, and it will mature on the first anniversary that the underlying measurement is above the reference level. So let's give you an example of a contract that we invested in last month. The bank behind this was Santander UK, albeit we've seen these with HSBC, Barclays, Morgan Stanley and the like. This particular one, it would mature after 12 months if the FTSE was higher than where it was when it started. So let's just say it starts at 5,800. In a year's time, if the FTSE is above 5,800, the investment will mature. It will pay a 10.5% gain and give you your capital back. That 10.5% currently subject to capital gains tax. So in the hands of many investors, they'll use their capital gains tax allowance. That will be tax-free. If the FTSE isn't higher than 5,800 in a year's time, it runs for another year. And again, if the FTSE is higher than 5,800 on the second anniversary, it will mature and it will pay 21%, 2 times 10.5. If it's not, it runs for 3 years, it adds another 10.5 simple on, and if not, 4 years, 5 years, 6 years. Now, if we get to the end of 6 years and it's higher and it hasn't been higher on the previous 5, well, we've had a pretty bad 6 years, but we'll get 6 times 10.5%. If it's lower, it will return our capital. Think about this in the context of whatever else you were invested in, unless it's lower by more than 50%, in which case this would track the index and give you an equivalent loss. Now, there's no dividends included in the FTSE 100 index, so again, when you're comparing it against alternatives, recognize the fact that if you're invested in a tracker fund, you're going to have some charges built into that tracker fund, but you're also potentially going to get dividends on the underlying investments. So for that particular contract, in order for you to suffer a loss, assuming that you hold it until its eventual maturity date, either the bank has to go bust, which means the rest of your portfolio is not going to be immune, or the FTSE has to be lower on the first, second, third, fourth, fifth, sixth anniversary and 50% lower at the end. Now, recognize again that if it's 49% lower, you're getting your capital back. That capital has been effectively eroded by inflation over that 6 years. But again, think about it in the context of wherever else you were invested, because if the market's 49% down and you're getting your capital back, you can then go and reinvest that element of your portfolio back in the market to benefit from the recovery. Now, don't use one of these in isolation. You can use a series of them and build a portfolio over the years.
Super. Thanks very much.
Thank you.